So at the moment, stocks keep dipping, and today we're going to talk about where I am seeing big opportunities at the moment. I've talked about this actually previously on the channel, but I feel like this is probably worth refreshing. And also, there's something more behind the S&P 500, because whatever happens with the S&P 500 is normally what we describe as what's going on in the market. So if the S&P 500 is up, we say, oh, everything's doing really well. If the S&P 500 goes down, we go, oh, everything's really bad. But there's a lot more under the surface, and today we're going to try and show that and some opportunities that are not just what is the S&P 500 doing, that's what the market's doing. So overall, I mean, the S&P 500, it has started to take a bit of a slump in the last couple of days. As you can see here, we did peak around the end of March. Since then, the S&P 500, actually from the all-time highs, I think it's a little bit more down than 4%. I think it's maybe 5%, so it's down 5%. Now, 5% isn't really anything massive. You know, when you come back in 2, 3, 4 years time, you won't remember, hey, do you remember that 4% dip that happened in March time? You won't really remember it. So it's not really a mega dip at the moment, but obviously I'm sure you're seeing a bit of suffering in your accounts at the moment, and it is another low for the 4th straight day. Now, when you actually take out a lot of the big tech of the S&P 500 and the big weightings of the S&P 500, that's when it starts to get a little bit worse. Because if you actually look at the S&P 500 equal weighting, you can see here that year to date, it's basically flat. We haven't really done anything year to date. And that's a big difference from when you look at the actual S&P 500 and we're up 6% year to date. So there's a big difference between the actual the S&P 500 and the S&P 500 equal weighting. We know we're basically flat. And then you start looking at that situation and then we're actually down 6% there. So we're actually now moving towards correction territory. You know, correction is recognised as a 10% dip in the stock market. So we are starting to move towards a correction in the equal weighting index. Now you might say, well, what's the big difference between the equal weighting and the S&P 500? Now, quite often people actually don't know the S&P 500 isn't equal weight. It's heavily weighted to the bigger market cap stocks, stock prices. So if you have a look at, for example, the weighting, Microsoft actually makes up 7% of the S&P 500. So even though there's 500 companies in there, Microsoft makes up 7% of the weighting. Now, really, when you look in here, the only stock that's having a tough time this year in the top 10 is Apple. Now, you could argue the case, well, the reason why these have more weighting is because the share prices have performed this year. That is true, but even without that aspect, these would have still made up a bigger weighting. So, for example, Apple is the only one that has performed badly in the top 10 this year. However, it's still top 2. And if you do start looking at the weighting of them all, Microsoft 7%, Nvidia 5%, Amazon 3%, Meta 2%, Google Class A 2%, Google Class C, a bit of a trick there. Google Class C 1%, 1.8%, Berkshire Hathaway 1.7%, Eli Lilly another 1.4%. I mean, I'm not going to add them up all briefly there, but I'm sure you towards 15% of the whole S&P 500 comes in them 9 stocks there. And then you start looking at them performers. Microsoft up 11% year to date. Nvidia up 74% year to date. Amazon up 20%. Meta up 42%. Google up 12%. Berkshire Hathaway up 9%. Eli Lilly up 26%. Broadcom up 18%. You can see here when an heavier weighting is to these stocks, you can see why the S&P 500 is looking a lot better than what it is. You start digging below those top 10 stocks and you start going more equal weighting. This year really hasn't been that good of a year so far. And you start thinking about if you don't actually own any of those big 10 stocks, it's a lot harder for you to have matched the S&P 500. There's a lot of investors out there at the moment, obviously. I mean, there's a few there will be honest and hold their hands up and go, yeah, I'm not doing that well this year compared to the S&P 500. And if you don't actually own any of those big tech holdings, you're probably struggling this year. Now, for me, I actually do own Microsoft, I do own Meta, and I do own Google. So technically, and if you class the Class A and Class C shares, obviously I own 4 of the kind of big stocks there. I mean, it's a bit cheating saying I own Google A and Google C. But also what helps me is that my other 2 big holdings in the portfolio, DraftKings is up a lot and HIMS is up a lot. So lucky for me, I'm actually beating the S&P 500 this year. But if it wasn't probably for them two, and a lot of people won't have them to, there's probably a lot of investors out here that's struggling to beat the S&P 500 at the moment. And when you actually take that context out of the equal weighting, you can see it's actually not as good as a year as what you probably would expect. So there's definitely opportunities outside of the big 10 holdings in the S&P 500 that have struggled this year. Now, this is where there's even a bigger opportunity, because people say like it's been a good year. When you actually look outside of the S&P 500 and especially the big 10 holdings, this is where I personally think there's a mega opportunity. The S&P 600. The S&P 600 is made up of smaller caps stocks. And if you look at the S&P 600, and I know I've said this for a few years on the YouTube channel, but the S&P 600 has basically been flat now for over 3 years. And in fact, if you look at the S&P 600, it's actually down 5% year to date. So when you actually look at the stock market in general, everyone goes, oh, the stock market's having a good year. But you start digging into it more and more, actually equal weighting, it's not as good as a year. You actually look at the small caps and the mid caps, the S&P 400, it's actually not that good of a year. And I've actually been seeing this opportunity for a while in the S&P 600, but the longer it stays down here, it's looking more and more of an opportunity. Now, the reason why the S&P 600 is probably struggling is because it's small caps. Small caps are a lot more sensitive to inflationary pressures. They're a lot more sensitive to the inflationary pressures and then the interest rate environment, so that's probably hurting them a lot. But there's a big disconnect here, because for the last 3 years, these stocks have been growing the profitability, the valuations have been going cheaper, and now they look even more attractive. And there was a little bit of a rebound at the back end of October time, but since then, it's kind of faded away, and especially in like the last few days, it's definitely faded away. And to kind of put that in context, if you look here at Yardeni Research, the red line here is the forward PE of the large caps. And you can see here, it's basically a lot higher than what it's ever been at. So the S&P is looking a little bit of a richer valuation. But when you look at the S&P 400, the mid caps, the S&P 600, the small caps, they are still, even though with a bit of a bump up here, by the way, this is taken from December. So from December time, what have we seen? We've seen earnings improve. So earnings are probably going to be lower in that PE. And also, since the start of the year, we're obviously down for the year. We're down 5%. So the combination of earnings improving and a drop of 5%, this December PE ratio of 15 and 16 is probably even lower now. So it's even more attractive from when these last numbers were taken up. But even then, it's relatively very low. You look at the history point of view, the only times we've been lower is the 2020 CV situation. We had the sort of back end of the crash of the 2018 time. Then you're going back to where there was the fear around the double dip recession. And then you're going back to the mega 08 crash. So the only times we've had the S&P 400 and 600 lower, the small caps and the mid caps have been lower, is during crashes. The first crash, the fear of a second crash, during the crash of 2018, the crash of the CV times, and now after that whole inflationary pressures and the 2022 situations. But yet we haven't really recovered. And then the other factor is this: the S&P 400 and 600 actually normally trade higher than the S&P 500. So you look here, look at historically it's been trading a lot higher apart from crashes. So we did have the crash, but we haven't even recovered. So if the S&P 500 is relatively trading at 19 times forward earnings, which I do think is a little bit rich, but then realistically, right now, the S&P, the small caps and the mid caps should be trading more towards 20, 21, 22 times forward earnings, which is a massive increase from where they are at right now. And even if the S&P 500 goes back to where it normally trades at, let's say it trades at 17, 18 times earnings, we should be 20, 21 times earnings. So the small caps, even though I've said for a while, I think they're very good opportunities, as time goes on and the earnings keep increasing, the upside for me is only increasing more and more. And I think this is where there's opportunity in the market. A lot of people say the market is overvalued. Yes, it's overvalued, but when you look at the S&P 500, that's where it's overvalued. And in particular, where it's overvalued is the larger cap companies. You start digging below the large cap companies, even in the S&P 500, there's some opportunities there. And then you start digging into the mid caps and small caps, there's even bigger opportunities there. And I think that even though we look at the market and go, it's a little bit of a rich valuation, that's when you talk about the overall market, the S&P 500. If you actually dig in lower, I think there's good opportunities out there, guys, and I think the opportunities are, I think there's some opportunities in the UK market, but in the US market, I think there's opportunities in the mid caps and small caps. Now, when you look at the small caps, they do tend to be around valuations of $300 million to $2 billion, and if you do look at the mid cap market caps, that's around $2 billion to $10 billion, and that's relatively where I was dipping into in previous times. I would dip it into DraftKings. DraftKings was $20, $10, and that put it down to a 10 billion market cap, 5 billion market cap. So that was one that I'd previously been dipping into, and obviously we've got some rewards from that. You look at Hims and Hers. I was dipping into Hims and Hers. Hims and Hers was a small market cap. It was around about a 1 billion market cap company. Obviously it's gone a little bit high now, still a bit of a small market cap, but it's increased. So I'm looking at the opportunities like, D-Local, which is a 4 billion market cap. I think this is a relatively attractive value for a company that is, 31 times earnings, but yet has come off a year where revenue is up, 58%, net income's up 47%. Those are fantastic numbers. Yet we're talking about a company that is 31 times earnings on a forward basis. I think it's like 21 times earnings. This is exactly what I'm talking about. This is what I'm actually, exactly talking about, that this is one of those small caps and mid caps. I don't know why it's down at these sort of levels, even though the results have been amazing. And you look at the share price, and the share price has basically done nothing for 3 years, right? And that's what we're talking about. S&P 500, S&P 600 hasn't really done anything for the last kind of 3 years. However, when you look at the, some of these companies in here, they've performed absolutely amazing. I think D-Local is one of those stocks. You look at SoFi. SoFi is one of those that I like to get SoFi more towards the $6 range. Personally, that's where I like SoFi. But even at low $7-ish right now. Same again, the stock hasn't really done anything for the last kind of 2-3 years-ish, which kind of falls into that kind of element of, what I'm talking about here. So for me, that's where I'm seeing a lot of opportunities now, guys. I think there is opportunities out there still. People say that the market's overvalued, but it's only overvalued when you look at those larger S&P 500s. I think if you start digging below the surface and you start looking at the likes of SoFi, you look at D-Local, there's I think Mercado Libre's not too bad of a valuation even right now. I think there's opportunities on there, and even in the S&P 500, I think you look at Walgreens at the moment. I think there's opportunities there. So I think the UK market is undervalued, but I think there's also good opportunities in the small cap markets at the moment. And I thought I'd point that out, because what everyone does is they'll look at the S&P 500, and that's dictated if we're in a good market or a bad market. But even when the S&P 500 doing what it's doing, even when we were up, even before we even had this dip, when we were up 10% year to date, I still think there was opportunities that were there, that were not really being talked about. People said, the market's overvalued, but I still think there was opportunities there when you start looking at some of the small caps and mid caps. So yeah, take a look there, guys. That's where I think there's a lot of opportunities out there, and that's where, particularly this week, I will probably be deploying some of my cash into those smaller market caps and the UK market. So yeah, hope you enjoyed the video, guys, and see you in a bit.